Insider trading is the act of making financial trades based off of information that is not openly available to the public. For example, a CEO buying shares in their own company because they know that the business is about to publish record profits would be insider trading. Once this report becomes available to everybody, more people will want to purchase the stock, increasing the price and making the CEO a very healthy profit with very little risk. It doesn't even need to be a CEO. Sometimes even entry-level analysts are privy to potentially market-moving information. At the end of the day, it's not going to be the CEO writing up the quarterly reports. This can create opportunities for people to make more than their annual salary by simply buying up some call options and waiting for the report to go public. Someone with a consistent flow of insider information on a single publicly traded company could easily make triple-figure annual returns, which could make even an investment of a few $1,000s turn into millions very quickly. The problem is that this practice is illegal. I think most of you already knew that. But should it be? It was only actually outlawed in 1934, and back then it was done only to stop company executives taking advantage of the market turbulence of the Great Depression. So, what's the harm? How does one executive making a bit of money equate to everybody else losing money? Especially since they are making those trades with willing counterparties who would have traded those stocks with someone else if not for them. So, it's time to learn how money works to find out if insider trading laws actually achieve anything, and to see why abolishing these laws could lead to more efficient and stable markets in the long term. Again, I find myself making a video on literal financial fraud, which is obviously not very advertiser friendly. Fortunately, I can keep making these videos thanks to the support I receive from my channel members and patrons on Patreon. So, thank you guys. The tricky thing about insider trading is knowing exactly where to draw the line. There are extreme cases which are obviously illegal, such as the rogue CEO or analyst that we used in an example at the beginning of the video, but some are harder to say for sure. I should add at this point in the video that I am not a lawyer, so don't be going and telling the SEC that I said any of this was legal or illegal. Even if I was a lawyer, it is impossible to say for certain where the line is drawn in any given case, which is actually a part of the problem. Consider this example. You walk into a 5-star restaurant and you are sat next to a CEO and a CFO of a large publicly traded company. The pair get a little drunk and start talking openly about how big their bonuses are going to be once their annual sales figures are released to the public. This sounds like good news, so the next day you buy up shares in their company, and sure enough, a week later, once their quarterly profits are made public, the stock rallies 20% based off the promising figures. Is this insider trading? On the surface, it looks to be. You had access to information that wasn't openly available to a general member of the public. You used that information to make an informed financial decision, and you profited off doing so. Even if this isn't insider trading for you, would it count as insider trading for the careless CEO who indirectly divulged this information? Well, actually, no, it would not. That's because even though the average investor would not have been lucky enough to come across the information that you gathered by being sat next to these two loudmouths, it was still announced to the public, albeit in a very limited forum. Okay, but what about if those tables were pushed together? Suddenly, the CEO and the CFO and you were all having dinner together and the same conversation took place. Then that would be insider trading because you would have been deemed as someone personally selected by an insider to have access to a forum where market-moving information is discussed. Well, okay. What happens if we assume that the CEO and the CFO are strangers in a restaurant again and we are just sitting next to them? Instead of discussing annual profits, they are discussing an acquisition that they are planning on announcing in the next week. You buy up stock in the company that they are planning to take over, and once again the value of the stock rallies and you make a very healthy profit. Sounds the same as the first example, right? You just happen to overhear something in a public place. Well, this unfortunately would be insider trading because information regarding mergers and acquisitions is held to a higher standard by the SEC, and there is the reasonable expectation for all market participants that this information is not public until it is formally announced. Let's consider another slightly morbid example. You are the member of a very prestigious golf club and you are hanging out on the 10th hole when you see a very influential CEO of a public company fall dead of a heart attack on the 11th. After hopefully calling an ambulance, you open up the Robinhood app and short the stock of that company. Would this be trading on insider information? Alright, final hypothetical here. Let's say you and your sister were math and science prodigies growing up. She used her talents to become the CEO of a Fortune 500 tech company. You, on the other hand, used your talents to try to beat the market as a day trader. You never trade on any information your sister or her associates share with you, but you do trade stock in her company as well as other competing companies since technology is the field that you know best. Your high performance alarms suspicion from the SEC, and both you and your sister are charged with insider information. How do you prove that you're innocent? The legal burden of proof lies with the prosecutors, but by that time, she might have lost her job and brokers may have decided not to work with you. Hopefully, you can see that through all of these examples, that drawing the line of what insider trading is and what it is not is incredibly difficult. In reality, no two parties are ever going to have access to identical sets of information when making a trade. A regular investor looking at Robinhood on their phone is not going to have access to the same information as a managing director on a Goldman Sachs trading floor. Artificially just restricting some people from making trades simply makes something called price discovery slower. Price discovery is the process of markets slowly finding the ideal price for an asset through people selling it when the price is too high or buying it when the price is too low. In theory, having a market price which is perfectly realized means that the price would be truly indicative of the underlying value of the asset. It might sound like financial jargon, but imagine if you could buy and sell shares knowing that the price of an offer is perfectly fair based on all information. It sounds great, but regulation against insider trading as well as other laws that hold back trading activity prevent that from ever being perfectly achievable. Now, price discovery and legal gray areas are far from the main argument coming from supporters of insider trading. Those issues pale in comparison to the fact that insider trading happens all the time, and it's practically impossible to stop at least 50% of it at minimum. This is not some rant about how the SEC is underfunded or anything like that. Even if the agencies in charge of cracking down on this kind of behavior had all the money and manpower in the world, they could still not stop 50% of insider trading. This is because of what is called omitted trades, or trades that insiders choose not to make. Let's think back to our humble analysts again putting together a company report which is going to deliver some kind of good news to shareholders. Because they are not deemed important enough in the corporate hierarchy, they do not need to publicly disclose their trades, nor do they need to plan them ahead of time like the senior executives do. Well, let's say that this analyst was trying to decide if they should sell shares that they were given as a part of their bonus last year. Once they start working on the report, they realize that these shares are going to be worth a lot more in just a few weeks, so they instead decide to hold on to them to wait until they are worth a lot more money and reassess what to do then. This is making a trade decision based on insider information. The reverse is also possible. If an analyst was going to buy shares in the company they work for, but then change their mind because they start working on a report that is going to deliver very bad news, then this is too making trading decisions based on non-public information. This is technically illegal, and it's why senior executives in America need to declare their trading plans months in advance. But unless you extend this requirement to all employees or start prosecuting literal thought crimes, it's impossible to stop this happening amongst every insider in the business. So, insider trading helps markets operate efficiently while being almost impossible to police and difficult to prosecute. Why do these laws exist then? Who does insider trading actually hurt? Well, it's not good enough to say regular investors, because that's not actually true. Insider trades need to be made with a willing counterparty. Nobody is holding the gun to a head of a regular investor and forcing them to sell their shares to a corporate insider. The regular investor and the insider agree on a price that they are both happy with. The regular investor on the other end of the trade would have no way of knowing who this person was, and they wouldn't magically be any worse off as compared to the reality where they just sold their stock to another regular investor. People holding the stock wouldn't be any worse off either. If the company is about to announce good news, then they will do well, and if a company is going to announce bad news, then they will do poorly. A few insiders trading on this news before it is public is not going to change the inevitable. On the contrary, these insiders might make the decline in price more gradual, avoiding some of the emotional trading that can be caused by public announcements. Alright, in the interest of fairness, there is one legitimate issue caused by insider trading, and that is that it can stifle market activity. To demonstrate this in a simple way, imagine that you had a stock market with only two participants, yourself and some corporate insider that knows everything going on in all of the companies listed on the exchange. Now, consider that this insider puts up an offer to buy some of your shares. Would you sell them? The logical answer is no, because this insider is only going to offer to buy those shares because they know that it'll be worth more soon based on some kind of information that they have but you don't. As with all of these examples, the same is true in reverse. If they offer to sell you shares, you should not buy them, because they are only going to offer to sell you something if they know it's going to be worth less in the future. This would cripple market activity and make it impossible for anybody to accept any trade without losing out to an insider. Except it probably wouldn't. In a market with just two participants, sure. But in a market with millions of participants and no way of telling who is an insider and who isn't, this really wouldn't be an issue. There would be one group that would miss out, however, and that is the speculators. People, or much more commonly institutions, that make trades based off a stock being undervalued or overvalued would find it much harder to make profitable trades successfully in a market where price discovery was more efficient. Would it be worth losing hedge funds and day traders in exchange for knowing that the stocks we buy are not going to be drastically altered by some report sitting on a desk somewhere? I'll leave that up to you to decide. Now, if you are still thinking about making a trade as the golfing CEO gets shipped off to a morgue, then fear not. What you did was morally reprehensible, but perfectly legal. If you enjoy moral reprehensibility in the name of profit, then you will love my video detailing exactly how Jordan Belfort made his millions in The Wolf of Wall Street. Thanks again to my channel members and patrons on Patreon for making it possible for everybody to keep on learning how money works.